Right now, for every single ounce of silver that actually exists for physical delivery inside the COMEX exchange, there are more than 100 paper contracts claiming ownership of that same ounce. 100 paper claims. 1 real ounce. And that number has been climbing for years, while the physical metal in the vaults has been quietly, steadily disappearing. This is not a conspiracy theory. This is not a fringe idea circulating on the internet. This is arithmetic, published data, public records. And arithmetic does not lie, does not negotiate, and does not care how long the system has managed to avoid the consequences of its own math. Welcome to Recession Warnings. Today we are going somewhere the financial media will not take you. Right now, the repricing will not be a gradual adjustment. It will be a single violent event. And most people will not understand what happened until it is already over. To understand why this matters and why it is happening right now, you need to understand something almost nobody in mainstream finance ever explains. Inside the COMEX futures market, the exchange that effectively sets the global price of silver, there are two completely different categories of silver sitting in vaults at this very moment. These two categories look similar on paper, but the difference between them is the difference between a functioning market and one that is already quietly failing from the inside. The first category is called eligible silver. The second is called registered silver. And once you understand what separates them, you will never look at the silver market the same way again. Eligible silver is real metal. It is sitting in COMEX-approved vaults. It is fully accounted for, but it does not belong to the market. It belongs to ETFs, private holders, institutions, parties who have placed their metal in a COMEX vault for safekeeping, but have no intention of selling it or delivering it against a futures contract. Eligible silver is in the building, but it is not on the table. You cannot buy it. No futures contract can claim it. It is simply there, in the background, giving the system an appearance of depth that does not actually exist when you look at the numbers that matter. The only category that actually matters, the only silver that backs the paper market, is registered. Registered silver is the inventory that stands behind every futures contract, every paper claim, every speculative position, every trader who bought silver futures and technically has the right to demand physical delivery. All of it, every paper obligation in the entire system, ultimately points back to registered silver. That is the foundation. And the foundation has been crumbling. Here is what has been happening to registered inventories, and this is where Recession Warnings needs you to pay close attention, because this is not normal market fluctuation. Registered silver has been declining, not sharply in any single dramatic moment, but steadily, persistently, for extended periods. And while the total number of paper contracts outstanding, what traders call open interest, has remained elevated. And what that creates is a ratio. Analysts call it the coverage ratio. It measures how many paper claims exist for every real deliverable ounce of silver, and that ratio has been collapsing. At certain points inside this market, for every single ounce of registered deliverable silver, there have been dozens, and in documented cases, well over 100, paper claims stacked on top of it. Sit with that number for a moment. If you had 100 people who each believed they owned the same house, and all 100 of them showed up on the same morning expecting to move in, what happens? That is not a housing market. That is a fraud waiting to be discovered. And the silver market right now is running the same equation. The paper price and the physical reality have been quietly, invisibly disconnecting for years. And here is what every serious market historian knows about disconnects like this. They do not unwind gradually. They do not give you a press release and a polite 3% correction. They snap. And when they snap, the move happens before most people even realize the rules changed. So if the math is this broken, if the coverage ratio is this extreme, the rational question every viewer is asking right now is obvious. Why hasn't it already failed? Why is silver still trading normally? Why are there no headlines about a COMEX collapse? The answer is a mechanism that almost nobody outside of professional trading desks fully understands. It is called the Exchange for Physical, the EFP. And understanding how it works is essential to understanding why the entire structure is still standing, and why that appearance of stability is exactly what makes this situation dangerous. When a large trader or institution that holds a COMEX futures contract decides they want to actually take delivery, meaning they want the real metal, not a cash payment, something interesting happens. Rather than reaching into the registered vault and pulling out the silver that was promised, the exchange and its banking participants quietly move the delivery obligation somewhere else. They transfer it to London, to the London Bullion Market Association, a parallel, much larger, and largely opaque global silver market that operates with far less transparency than even the COMEX. The original contract gets closed. No default is recorded. No alarm sounds. No headline appears anywhere. From the outside, the system looks completely stable. But what actually happened is that the pressure, the physical demand that could have exposed the coverage ratio problem, was quietly exported from one stressed system into another. And this is where it gets genuinely alarming. Because London is not a limitless reserve of silver. The LBMA is not an infinite vault absorbing every obligation the COMEX chooses to redirect its way. The data coming out of London over recent periods has been consistent, and it tells the same story. Inventories there are tightening as well. So the EFP mechanism is not a solution. It is a pressure valve. It moves the stress from one vault to another. It keeps the surface calm while the structural weakness underneath continues to grow. And every single time it is used, the problem does not disappear. It compounds. The reckoning does not vanish. It simply gets deferred, with a slightly higher price tag attached to it each time. The system has been using this mechanism at scale, and scale matters, because the more frequently physical demand is redirected rather than satisfied, the more fragile the entire chain becomes, until one day the redirection fails. And on that day, there's no quiet transfer. There is only the math, finally visible to everyone. Now we need to go one level deeper, because what we have covered so far, the coverage ratio, the EFP mechanism, the tightening inventories in both New York and London, that is only the visible layer of this problem. Underneath it is something more fundamental, something that has been built quietly into the financial system over decades. And once you understand it, the phrase "I own silver" will mean something very different to you than it did before. In the financial system, particularly inside the London market, metal can be leased. Here is how it works in plain language. A large institution or sovereign entity that holds physical silver, a central bank, a pension fund, a government reserve, lends that silver to a bullion bank. The bullion bank takes possession of the physical metal and sells it into the market to raise cash. They now owe the original owner the silver back at a future date. The original owner looks at their balance sheet and sees their silver fully accounted for, perfectly intact on paper. But the physical bar is gone. It has been sold. It is sitting in someone else's vault, or it has been fabricated into industrial components, or it has moved across borders into a completely different market. On paper, one institution owns it. In reality, someone else has it. And in certain structures, the process repeats. The new owner uses the same bar as collateral for another transaction. The same ounce backs multiple positions simultaneously. Multiple parties all hold documentation showing legitimate ownership of the same physical silver. This process is called rehypothecation. Think of it this way. Imagine you own a car and you park it in a paid garage. The garage, without telling you, rents your car to someone else while you are at work. That person drives it to another city and rents it to a third person. 3 people now have a key to the same car. All 3 believe they have access to it. The system works perfectly until all 3 show up at the garage at the same time. That is rehypothecation applied to silver. 1 bar, multiple keys, multiple parties who each believe they own it, and the system functions without visible failure for as long as nobody asks for the actual metal simultaneously. This is fractional reserve finance applied to a physical commodity. And it is not a bug in the system. It is a feature, used deliberately, legally, and at enormous scale. The critical variable is what happens when the demand for physical metal exceeds what the paper system can quietly satisfy. And that brings us to the trigger. Not an economic crash, not a Federal Reserve announcement, not a geopolitical event, though any of those could dramatically accelerate the timeline. The actual trigger is something far simpler and far harder to predict in advance. It is physical demand, specifically physical demand that arrives at a scale and from actors who cannot accept a cash substitute. Industrial manufacturers who need silver for solar panels, semiconductors, medical devices, and electronics are not speculating. They do not want a futures contract. They do not want a cash settlement at spot price. They need the actual metal to continue production. When a solar manufacturer in Germany or a semiconductor plant in Taiwan places an order for physical silver, and that order cannot be filled at any reasonable price, that is not a financial event. That is a supply chain crisis, and supply chain crises move fast. Alongside industrial buyers, the second category of actor capable of triggering the brake is sovereign. National governments and sovereign wealth funds that have been quietly building strategic metal reserves do not operate on retail timelines. When a government decides to convert paper holdings into physical reserves, the order sizes are not measured in ounces, or even thousands of ounces. They are measured in tons. And a single sovereign transaction of meaningful size, arriving into a market where registered inventories are already depleted and EFP transfers are already straining London capacity, could be the event that makes the coverage ratio visible to everyone simultaneously. The third category is institutional traders who have done this same analysis, who have read the inventory data, mapped the coverage ratio, and made a deliberate decision to stand for delivery on their futures contracts rather than rolling them forward or accepting cash. If enough of these actors coordinate, even accidentally, simply by reaching the same conclusion independently and acting on it in the same window of time, the chain of paper ownership gets stress tested in real time. And stress tests of fractional systems have one consistent historical outcome. They fail, not partially, not gradually. They fail at the point where physical reality can no longer be papered over. So what does Recession Warnings tell you to actually watch? Not headlines, not analyst commentary on financial television, not the paper spot price on any given morning, because that price, by definition, reflects the paper market, not physical reality. Watch cash settlements, specifically. Watch for a pattern where large contract holders who expected physical delivery are being quietly, financially incentivized to accept cash instead of the silver they paid for. In a healthy market, cash settlement is a routine and unremarkable convenience, but when it becomes a pattern, when it appears consistently during periods of elevated open interest and declining registered inventories, it stops being a convenience, it becomes a signal. It means the physical metal is not available at the scale the paper market implied it would be. Watch the lease rates. When silver lease rates spike, when it suddenly becomes expensive to borrow physical silver, it means the metal is becoming genuinely scarce at the institutional level. Lease rate spikes are not visible on most retail platforms, but they appear in professional data, and they have historically preceded significant price dislocations. Watch the premium divergence between paper spot price and the price of physical coins, bars, and rounds at actual dealers. When the premium a retail buyer pays above spot begins to widen significantly, not the normal 2 or 3%, but 10, 15, 20%, it means the physical market is already pricing in scarcity that the paper market has not yet acknowledged. And finally, watch delivery volumes. When the percentage of futures contracts that go to actual physical delivery begins rising, when more and more contract holders choose to take the metal rather than roll or settle in cash, the pressure on registered inventories becomes visible in public COMEX data. A sustained rise in delivery elections, combined with declining registered silver, is the most direct observable measure of the stress Recession Warnings has been describing. These signals do not all have to appear simultaneously. In historical precedents, in the Hunt Brothers episode of 1980 and the silver spike of 2011, some signals appeared weeks or months before the main event. The market gave warnings. Most people missed them because they were not watching the right data. This time, you are watching the right data. The structural conditions are present. The coverage ratio is extreme. The EFP mechanism is being used at scale. London inventories are tightening. Industrial and sovereign demand for physical silver continues to grow, while registered inventories continue to shrink. The system is not broken today, but it is operating on borrowed time and borrowed metal. And the distance between where we are now and the moment when physical demand exceeds what the paper structure can absorb is not infinite. It may not even be long. When the break arrives, and in a system with this level of structural stress, the break is a matter of when, not if, it will not look like a normal market correction. It will not give you a headline and a 3-day window to respond. It will be a repricing event, sudden, violent, and largely over, before most investors understand what caused it. The only variable that matters now is whether you understand what is coming before it arrives, or whether you're still trying to understand it after the fact. This is Recession Warnings, and we will be watching every signal, every inventory report, every lease rate spike, every delivery election, so that when the math finally becomes impossible to ignore, you already know exactly what you're looking at.